I'm Dawson Schmidt here with the latest stories and developments in this week's Commodity Roundup on Trader PhD. Corn and soybean crops are headed into their final development stages in the U.S. The USDA's crop progress report on Monday showed that 44% of the U.S. corn crop was dented, which was exactly the same pace seen last year, as well as the 5-year average. Corn entering maturity reached 7% compared to 10% last year, but was on par with the average. Corn conditions were unchanged from the previous week, with 71% of the crop seen in good to excellent condition, which was the best condition for the week since 2016. For soybeans, the USDA reported that 4% of the crop had dropping leaves, down 2 percentage points from last year's pace, but progress aligned with the 5-year average. Warmer and drier conditions across the Mid-South and Southeast have been leading to leaves dropping well ahead of the average pace, according to USDA meteorologist Brad Rippey.
For example, in Arkansas, one of our hotter states recently, 23% dropping leaves, 5-year average there, 17%. Similar picture in Mississippi, 39% dropping leaves, 5-year average, 25%.
Meanwhile, Midwestern crops have just begun undergoing maturity. 2% of the crop had dropping leaves in Illinois, Indiana, and South Dakota. The soybean market is still waiting on U.S. export sales to China to emerge, as the country has remained absent from the sales sheet outside of its typical window. As of the week ending August 14th, outstanding sales for the 2025 and 26 marketing year totaled just 5.9 million metric tons, or 215 million bushels. That was down 22% from the same period last year, and the lowest since the first trade war with China during the 2019 and 20 marketing year. Again, zero of that is for China. Before the first trade war, China typically began purchasing new crop soybean sales from the U.S. in January. However, turmoil over the past decade has led to uncertainty in the new crop purchases. Soybean production growth in Brazil has allowed China to also phase out those early U.S. purchases. Limited export business in the Pacific Northwest due to China's absence has been leading to significantly lower basis, particularly in North Dakota. The average basis for the state during the October delivery period fell nearly $1.50 under the November contract this week. That puts the average cash price at about $9 a bushel. A weaker basis has also been seen this week in parts of South Dakota, Minnesota, and Kansas. Friday's cattle on feed report last week leaned on the bearish side of pre-report estimates. However, it still confirmed lower U.S. feedlot supplies. The August feedlot inventory totaled 10.92 million head, down 1.6% from a year ago. The total herd fell below the 11 million head level for the first time since 2019 and was the smallest August inventory since 2017. Meanwhile, July feedlot placements totaled 1.6 million head, down 6.1% from last year. It was also the lowest July placement estimate since 2016. Southern states continued to experience year-over-year declines, especially with the suspended cattle imports from Mexico. Northern states saw higher year-over-year placements, but that was only offset some by declines in the South. Seasonally, we should see total inventory declines throughout August due to seasonality, but limited supplies outside of feedlots will be a limiting factor, according to USDA livestock analyst Anthony Fisher.
The lower placements overall, they're reflective of limited supply of cattle outside feedlots, which was down 2% according to the July cattle report. In conjunction with only slight signs of heifer retention from the July cattle on feed report, this has resulted in a smaller pipeline of available cattle despite a strong pull into feedlots this year, as evidenced by record high feeder prices.
Fed cattle marketings last month totaled 1.75 million head, down 5.7%, which did align with market expectations. Despite lower year-over-year marketings, Fisher says strong demand for beef has kept cattle moving in and out of feedlots.
As for marketings, we're still seeing strong demand for beef, as evidenced by high wholesale beef prices, which is ultimately supporting the Fed steer price.
Thanks for watching. I'm Dawson Schmidt, and this has been Trader PhD.